what we're going to see in a lot of IPOs is just this desperate need for liquidity right now. So there is a whole glut of private equity and venture-backed businesses that have a very big need to come public.
We're particularly interested in situations, capital cycle events where you get a flood of new issuances and then the public market is overwhelmed, something changes and everything gets thrown out. And that really creates your incredible opportunity. The crazy thing is we're sitting here today in September of 2025, and some of our newest investments are still orphaned public companies from 2021.
This episode is brought to you by Fundamental Edge, the leaders in buy-side analyst training. You'll hear more about their new AI Academy later in the show. Let's get into it. Before we get started, I want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is marketing or advertising for Stoic Point or any of their funds. Everything is meant to be informative. Hello, everyone. Welcome to Other People's Money. We're doing something a little different today. We're going to be talking about markets, and I have two exciting fund managers on, Cullen and Shah. They're the co-founders of Stoic Point Capital Management, a concentrated long-short equity investment firm founded in 2018. At the end of this interview, we have a more OPM classic episode where we talk about Stoic Point, their growth, and how they think about the business of investment management. But in this first half, we're going to be talking about markets. And guys, I want to start with something that we've been talking about offline, which is how the current market environment compares to 2021 and 2020. Anytime those years are brought up, everybody thinks about the bubble and sort of the onslaught of new issues that we got sort of right before the peak. When you think about the comparisons that people are making between now and 2021, what are the most accurate comparisons and what are some of the nuances that people are missing?
There's actually an argument to think that we could be early innings of where we were in 2020. We were just reminiscing about how this all last time around, it was kind of the end of 2020. We had the first signs of excitement. Then we had GameStop in early 2021. Raj and I still remember the beginning of 2021 and just hearing that people were not shorting anymore. They were stopped shorting. You can't short stocks. Nothing makes sense. Bill Wang is cornering the market for highly shorted stocks. And it went on for another almost 18 months. It wasn't really until kind of the spring of 22 that it all started to unravel. And so you could have been saying some things we're saying now in terms of it feels a little euphoric out there, but it carried on for quite a time. And, I think the things I'd call out last time is we had zero interest rates and we had a lot of money sloshing around in the system from COVID stimulus. And now we have higher interest rates, but, looks like they're going to be trending downwards. What rate, we don't know. And we probably have less stimulus still out there, but seems like an administration willing to do anything to stimulate the economy, most likely. So who knows? We very well could be entering the early innings of another regime of a lot of money and low interest rates. And, I think one thing maybe Raj can elaborate on this too is the themes are similar this time, but different. And they seem a little more targeted at the moment than the last time we went through this.
We used to joke that there was a lot of electric vehicle companies that came public, if you remember, or like electric vehicle, or I'd call it electric vehicle adjacent companies. And Cullen and I used to joke that a lot of these companies were nothing more than just a drawing in a dream. And now the themes, you could kind of say it's like a coin in a dream. There's a lot of crypto stuff. There's a lot of crypto treasury stuff. Anything in an adjacent, add to that, anything having to do with this administration or MAGA. And then especially, obviously, the big, elephant in the room, or the big thing that's underpinning or underlying all of this is AI. And that anything that touches that tends to get quite a bit. So it's a bit different in terms of the themes and things that people are attaching themselves to, but the behavior remains in a lot of ways the same. I think the other thing, though, that feels, at least for now, a little bit different. If you remember all of the meme stock mania and the massive squeezes, Bill Wang stuff, that stuff we now know in hindsight what were, in fact, you had some very large squeezes out there. You had, in the early parts of that cycle, you had short sellers doubling down and continuing to add to positions and being sort of stubborn. Now we see on these days where you have the baskets like the Goldman VIP or the highly shorted baskets, and those days where that's up a lot, it's actually quite amazing the speed with which, and you see it in the prime brokerage reports that you get from Goldman or Morgan Stanley or otherwise, that the speed at which gross is getting slashed really quickly at funds across the street. As soon as there's a hint of that, it happens really quickly. Whereas last time around, it obviously took quite a bit. And you saw these big moves. And I mean, the funny thing is with some of these, the meme stocks now is you read the chatter and a lot of what people are saying, and it's still them versus us. Let's squeeze them. We're fighting the big guy type of dynamic. Yet this time around, I think there's a lot less of that big guy there. It's a lot more of rallying around something, this boogeyman that might not actually be there. That in the case of retail, they're really pushing towards. So yeah, it's similar in a lot of ways, but it's different, and it definitely does seem like we could get a lot further down this before, a lot worse or a lot better, depending on what side of the table you sit on, before things change and we need to revert again.
Well, I know particular for you guys, like that period changed a lot in the way you think about your strategy and some of the stuff that you do today. So you've got to be licking your lips, looking at a lot of the stuff that's going on. And I have to ask, if you don't think we're towards the end, what is the playbook for right now?
If you ask our clients, we talk a lot about de-SPACs and SPACs and new issuances, but it's a subset of things we look for in opportunities we pursue and investment ideas we find interesting. And it's at the center of all of them ultimately is change and change events. And new issuance is in a lot of ways a change event. It comes with a lot of potential changes around the shareholder base and around the company itself. So that's why it's one of the reasons why we pay attention to it. And we're particularly interested in situations, capital cycle events where you get a flood of new issuances and then the public market is overwhelmed, something changes and everything gets thrown out. And that really creates your incredible opportunity. In 2022, middle to late to 2022, we went around telling as many people as we could. We weren't on a podcast at that moment, but that there is some really crazy stuff here. There were these de-SPACs and there's some actual real businesses that are good to great businesses and they've been completely washed out. They trade at, negative enterprise values or extreme discounts to any relevant peer company. And we got a lot of people saying, that's really interesting. Like, let's see how it goes. And then we had, from that moment on, we delivered on every, and on many of the things we thought would happen. And these de-SPACs re-rated. And we went back around at the kind of into 2023 and into 2024 and said, look, it turns out that there wasn't really anything wrong with these companies. They were just being overlooked. And then the feedback was, well, that's over. So what else is there left to do? And the crazy thing is we're sitting here today in September of 2025, and some of our newest investments are still orphaned public companies from 2021 that went public sometime in the 2021 era. And two of them are de-SPACs. One of them is just a broken IPO, but these are companies that have had to undergo. It isn't just the fact that they went public at the wrong time. They went public at the wrong time and then a bunch of things happened with the business and now they're in no man's land. And yet the capital event was 4 years ago at this point. And so there's always going to be something to do. It's incumbent on us to find it. But we still, even today, before we even started to think about what else might enter the public markets over the next couple of years, we still find opportunities in the things left behind from the last capital cycle. So, there are lots of things we look at and new issuance is one of them. But for the time being, because we haven't seen anything particularly compelling, at least on the long side, coming through the new issuance market so far, we have focused on other areas of opportunity.
I know obviously you guys play in the small cap world, but one broken IPO that was getting a lot of attention is people saying it was mispriced to the downside. Now Figma has come down. That's really the only IPO that I can think of that is getting any press. Are there things that we're missing?
No, I mean, it's funny. The people who were screaming about how underpriced Figma seem to be a lot quieter these days, but they'll chime up again when the next IPO comes. Look, it's a tough job to fundamentally match demand and supply of where you and place and try to pick your shareholder base. I think when you're coming public here, and then everybody's a critic when it goes horribly right or horribly wrong. If they mispriced it the wrong way and the stock went down, there would be a lot of criticism too. And that's not defending the IPO as a mechanism necessarily. There are multiple ways to come public, and companies come public for a variety of reasons. It used to be that oftentimes companies came public purely to raise capital. Like that was a good way to do it. If you priced your equity and your cost of capital was appropriate, coming public was a nice way to do it. Obviously, private companies have a whole host of options now for raising financing if they want to stay private. And so they don't need to do that. I think the predominant reason now I think was certainly during the last cycle, maybe the number two reason now is to give employees liquidity. I mean, some of these companies have been private for so long, and you want to retain and attract new talent. So you go public to have a kind of a currency to do that and to provide liquidity. But again, there's options and mechanisms today to do that. Cullen and I have friends who run funds, and their business is purely going out and acquiring these shares in private companies and effectively trying to make money that way in a sort of pre-IPO stage, or even trading hands at premiums on private markets. The interesting dynamic that I think is happening right now, and I don't know necessarily that Figma is indicative of it, but I think it is going to be what we're going to see in a lot of IPOs, is just this desperate need for liquidity right now. So there is a whole glut of private equity and venture-backed businesses that have a very big need to come public. And they're all lined up at Goldman and Morgan Stanley's door right now too. But those doorways are narrow, and those banks can only do so much. And so it's going to be interesting to watch over the next, year, 2 years, how people come public and at what valuations, because the liquidity thing is very real. It's interesting. I got invited to go to this dinner with the Cancer Research Institute a few weeks ago by a friend. And the dinner was attended by a number of very senior, very well-known cancer researchers who work at a large Ivy League institution. And they were lamenting that, and look, now they were raising money as well. So, maybe take this with a grain of salt, but I tend to believe them. They were lamenting that the NIH cuts had resulted in them having to lay off a bunch of postdoctoral fellows who were doing some really critical cancer and immunology research. And my question to them was just very simply, well, the college that you work for, the university, has a multi-billion-dollar endowment. It's one of the largest endowments in the country. If not now, when would an endowment step in to help, back that funding gap and really continue to push forward this groundbreaking cancer research? Almost before I could finish my question, the research doctors, these are like PhDs, these are academics and researchers, were like, oh, well, the endowment's completely illiquid. They're tied up in a bunch of private equity and venture-based investments that they can't get out of right now. So there's really no money to go around. And I'm like, and this is kind of crazy that I'm sitting here at a research center, and the people who are doing cancer research know that the endowment has a liquidity issue. And so I think if you think about, that's a real world impact of, I think, what we're seeing. But what I think downstream it's going to result in is a lot more pressure to get these private companies public. And whether that's through the IPO mechanism, or whether that's through the SPAC or direct listing or otherwise, I'm not sure. It's going to depend on what each company needs, but it is going to make for a very fertile hunting ground, I think, for people who sit in our seats over the next couple of years.
Now, Cullen, do you see a bifurcation in the private companies and the reasons they haven't gone public? You've got companies that can tie their name to AI in any way, are just getting rounds, markups constantly. And then you have the people who haven't had a round in 3 years. They missed that window in 2020, 2021, and they're still maybe at a valuation that they can't justify. And they're waiting until they can find some way, or their hand is forced. Do you see that sort of breakdown between these private companies that are waiting for the door?
Yes. I mean, it's a bit of a tale of two cities, because front and center hitting us every day is some AI company has raised at, 3 times the valuation they raised that earlier this year. And so clearly there is success out there, and companies are raising more capital. The question is, what about the rest of them? And what does that mean? I mean, there are a lot of levers to pull. Raj, I was joking the other day, there was news about a private equity firm raising a $3 billion continuation fund. And Raj and I, we have a small hedge fund, and we've tried to raise capital. It's very hard to raise capital. And imagine being like, I'm going to raise $3 billion for a continuation fund to put these crappy investments I made from the last cycle into another fund. And you can raise $3 billion doing that. So, like, the levers are being pulled, and it's a question to play this out. And our theory is that, yes, they need liquidity events. They need to get public, and they want to do that at the right time and with the right metrics and a story for public markets investors. And they're working their way through the system. they're going to have to come at some point. There's only so many continuation funds. There's only so many extensions you can do on these things. And now you're probably entering a scenario where, Figma was, at least for, a big success there. I mean, I think we've joked about this. The one that happened right after Figma was a company called Bullish, which is a crypto exchange, which doubled on the IPO. And if that's not a sign, I think the ticker is BULL. So that's not a sign of what the environment is right now. But you've got to get these marquee deals out there, and then the door could open for the rest of them. But we have a feeling that then the real question would be, will anybody ever return to the SPAC structure as a viable option for, a quote, real business to go public? We'll see. We never count out people's desire to create liquidity events and desire to get a good mark any way they can. So we're optimistic just from, look, we play in the public markets, we play in small cap securities. And for the longest time, going really into 2021, the story was the public markets are dying. Everything happens in the private markets. There's fewer and fewer public companies. And then we got 1,000 new public companies over the course of a couple of years between SPACs and IPOs. And that's great for us because it just expands the universe and the opportunity set. And so if we get another opportunity like that somewhere along the way, that'd be great. But, it's up to these owners of these businesses to decide what they're going to do with them and for how long and how responsive they are to partner pressure to get distributions going.
So as we've established, there aren't any new issues for you guys to play around with. Actually, the orphan securities from that 2020-21 period are where you are looking. Are there any other areas of opportunity when you see these retail squeezes? Is that something that you guys play in at all?
Yeah, I'd say generally the retail-driven squeezes, the retail-driven narratives are usually more trouble than they're worth, and they end up eating up a bunch of mind share. Like, I'll confess, you probably 2-3 years ago, you'd see some of these things, kind of the last GameStop-ish cycle, not necessarily with GameStop specifically, but you'd see these random SPACs rip, and your initial and almost immediate reaction is, I should be shorting this, or I should try to figure out what's going on here. Or I'll put a starter position on one way or the other. And what it ends up being is just a massive time sink. If you put a 25, 50, 100 basis point position on, it's almost like in the back of your mind, it's treated. And when you go to bed at night and wake up in the morning, it's treated as if it's a 500 to 1,000 basis point position. And that's just not an efficient way to operate. And they take a life of their own and for, an inordinate amount of time. So we generally have stayed away from those situations. Thankfully, we've never really gotten scarred or burned too badly learning that lesson. Because I think it is a lesson. This is a dynamic that's only really, come to be mainstream over the last couple of years. But there is a lot going on, and there are a lot of things to pay attention to. As Cullen mentioned, our strategies are focused on change events, and there is a lot of change and a lot of volatility. One of our favorite buckets to look at is management change, and another one is transformative M&A. And there has been no shortage of that. And I mean, it's almost kind of interesting. It's not coincidental. If you think about the space, if you start to stack and overlay these misunderstandings, as we call them, or these change events, you can kind of get, where's the ones where I can tick off the most amount of misunderstandings? And Cullen and I actually maintain a list when we're evaluating an opportunity and we go through our investment scorecard and checklist, we actually tally up the number of misunderstandings. So imagine a situation where you have an IPO that's gone straight down and it's resulted in board turnover and management change. And in the middle of that, there's been something that's structurally happened with the business, or they've done an acquisition and maybe that ties into it. And you start to stack these on top of each other. You step back and you're like, wow, that is a potentially very, very interesting situation that if I can get my head wrapped around, I'd really like to be involved with. And so we tend to get drawn to those types of situations. It's a really fun thing to be doing in a year like this, where there are all of these AI tools that are coming on the forefront, and you can use them to quickly identify situations that look like that. We recently just wrote about in our letter a relatively new investment for us that we got to and arrived at through our idea pipeline by using some of these AI tools that said, hey, we've always wanted to look for new CEO change. That's always interesting. It's usually a good catalyst to get some new blood in there. But if you use traditional Bloomberg data or other data to try to find that, you get false positives. Oh, it's an interim CEO that's a board member who came on who's babysitting the business. Things are not going right. That's not that interesting. But what if you could find an outsider CEO, and not just an outsider CEO where you can pretty quickly tell that their track record was quite good at the last one or two companies that he or she was at, that they delivered a lot of shareholder return, and the stock's down and they bought stock, or the company's bought stock that's signaling confidence. And you start to stack all these things on top of each other. Those are super compelling change events. And there's really been no shortage of those, amidst this backdrop of short squeezes and meme mania and retail stuff. So we've been pretty busy. It's really more a matter for us, for our return on time, of fast failing new things that come and hit our desks.
In the last year, the advancement in tools for AI investment research has been absolutely staggering, especially for professional equity investors. Despite this, uptake from the industry has been relatively slow because of questions about data quality, hallucinations, and how to properly augment existing workflows. These questions are valid, but the key question remains: can AI be used to speed up and improve the quality of investment research? Our partners at Fundamental Edge have spent countless hours working hand in hand with the technology providers and money managers on the leading edge of AI adoption, and they believe the answer to that question is a resounding yes. That's why this September, they're kicking off their first ever AI Academy for buy-side professionals. In this course, you'll get an 8-module curriculum led by their head trainer and supplemented by dozens of other experts, including managers already using AI and the industry's top technology providers. You'll learn about the evolution of these tools, what they can and what they can't do, insights for prompting, and so much more. Most importantly, you're going to learn how to deconstruct, analyze, and augment your existing investment process, not replace it, so you can do the research you're already doing better and faster than before. There are literally too many topics and experts on the curriculum for me to list here, so go to the link in the description and check out the syllabus for yourself. The course kicks off in just a few weeks and space is limited, so check out that link and reserve your spot today. Now back to the show. So when you evaluate, obviously you get just notification that you have a CEO who fits some of these criteria, but you do have to drill down and say,
Totally.
what's going on at the business, and does the CEO have a track record of success? So when you are evaluating a CEO change, what are the key factors that you like to see?
I think on the CEO front, it really does have to do with what their past actions have resulted in. It's very easy to suss out if the new CEO was the CEO of another public company before, because what's the easiest barometer to measure them by? It's the stock price during their tenure. It's a little bit harder when they were perhaps running a division of a company, and so the entirety of that company's market cap or equity value wasn't solely determined by the performance of that individual. But that is still something you can suss out. The beauty of the day and age we live in is, especially with LinkedIn, especially with expert networks, is you can start to dial up people who worked with that person, who may be able to opine on their performance and their strengths and weaknesses. But that requires a little bit of further digging. I'd say you're probably in your second or third inning of doing diligence on that individual by the time you get there. There's just a wealth of information out there that you can find online for people too. And so one of the ways in which we've been doing it is using some of these AI tools to effectively piece together a bit of a mosaic about a person's past and where they did things and where they didn't do things, and what people have said about them. And it's amazing how much you can find out about someone. It used to be just Googling them, and it actually wasn't that much. But now using some of these AI tools, now digging deeper into places like LinkedIn, how much you can find out about a person, their degrees of separation from other people you may know, et cetera, just by spending some time on the internet. So we spend a lot of time thinking about that when we're looking at a new individual taking a role or taking a seat at a business. And also thinking about what may have motivated them to take that in the first place. Were they fired from their previous role? Have been sitting on the beach for a long time? Or did they come over here because there was some sort of upside that you want them, to be incentivized alongside with you?
Yeah, this is again back to what's the environment we're in and what opportunities are being presented, just because this has happened real time to us recently, is you have a lot of companies out there that grew up with founders and CEOs who were all growth all the time, no limit to how much you could spend to grow, and investors reward for that. And then they got public and it was like, oh man, sorry, we changed our minds. We'd like you to be profitable. And if you want a good valuation, you now need to still grow, but you need to be go towards profitability or already be profitable. And that isn't always the same person to take you from that stage to the next stage. And also many of these CEOs, again, back to the 1,000 new companies, a lot of them are first-time CEOs, never been public CEOs before. That in itself is, you could argue, a unique skill set. And so in those situations, we may be looking at a company that's brought on a new CEO who's an adult in the room. They finally have brought in somebody who's got some gray hairs and operational rigor. And sure, maybe the growth profile isn't nearly as exciting as it was under the original founder, or the first CEO, the second CEO, but they're going to deliver on operational discipline. They're going to get this company to a position where we feel like the public markets will put a higher multiple on it because it still has a growth opportunity, may not be nearly as exciting. It's going to need a new investor base who is comfortable underwriting lower growth, but higher profitability. And then they have a track record of having executed on something like that in a previous role. It is one thing to just say, I've been CEO of a company, and so I know what I'm doing. It's another to say, I've seen this specific example. I've had to lay off 10,000 people over the last 3 years. And at this company, I need to cut the workforce by 10%, which is a smaller business. It's only 100 people, et cetera, whatever it might be. Those are the signs you're looking for. But again, it's really then dependent on what's happening at the company and what type of business it is.
You guys are on social media, and if you are following you, it's pretty easy to tell what your favorite position is at the moment. It's EVLV. It is your largest position, at least that's my understanding. Can we talk about this name in particular and what a large position means for you as concentrated investors?
I'll start off with just a quick disclaimer that obviously nothing relating to this security or any security that we discuss should be construed as investment advice. This is investment advice. This is really purely sort of providing examples, using maybe some specific securities, but definitely not a recommendation here. More about our philosophy and approach, especially as it relates to social media. So you're absolutely right, Max. I mean, I think on our social media presence, I think we've tweeted a lot about Evolve. I think one of the common factors sort of threading all of that together for us, both because I think it really is relevant to that particular stock and situation, but also I think is a good way to approach, the new era of social media as an investment manager, as an advisor, is our tweets really mostly pertain, or almost entirely pertain, to the company itself or the product. Going back to everything we talked about new issuances and stacking misunderstandings, I think the interesting thing about that company and that situation is just the sheer number of misunderstanding and change events you could just keep stacking on there. And I mean, really, a lot of those stacked on, after we got involved, initially, but obviously originally our drawing to these types of scenarios was new issuance, shareholder rotation based. And then what we, effectively underwrote is a very interesting product market fit opportunity for a company. Like I said, we have a lot of growth mindset with some of our secularly growing businesses, but we tend to think about things in terms of asymmetry. And what we really liked in this particular situation was a very large cash cushion at that time, a very low valuation as we perceived it to be, relative to a very large market opportunity. And it's not a large market opportunity that I'm happy that we have, or that the company has. That market opportunity is the gun violence epidemic that plagues the US, that I've said in the past, over the last few weeks, we, unfortunately are tariff-free exporting to other countries now, as globally, this is becoming more and more of an epidemic. But that is the backdrop and market for this business. And against that, they sell a product that I think a lot of people would argue is very, very effective at addressing that, especially in venues like schools and hospitals and stadiums and houses of worship, and so forth. And so that backdrop was really interesting to us. The reason, we really got it involved there was, as I said, the great degree of asymmetry there. But what really raised our conviction was a controversy. We have a mental model here called crisis and controversy, which we tend to get drawn to so much, in as much as we can underwrite the quality of a business and really perceive we have a good, handle on it. And the situation with Evolve, I think, was unique and is still very unique, in that a lot of the controversy about the business tended to center around this assertion from a so-called, and I'm using air quotes here, industry expert about the efficacy of the product, and claims that party was making that the product effectively wasn't working, that they were mismarketing it, et cetera, et cetera. Well, if I were to go and tell you, Max, that a product that you own or that you use doesn't work, or that you were doing work on, probably one of the first two things you do if you wanted to ascertain if that was true is go ask people who use that product. And what struck us really interestingly about this situation is in talking to short sellers and talking to people who made that assertion, we found 0 instances in which any of them had actually dialed up a customer. And to us, it's like a very basic, I don't know, 1990s era, what do hedge funds do type of work, which is go feet on the street, go talk to customers, go see what's actually happening out there. And I think what was amazing to us about this situation is we got resoundingly positive feedback, not only that the product worked, but that it was a game changer for the customers that were using it. And this is a product, and this is an industry in which word of mouth is so, so powerful. Existing customers are absolutely reference customers for new people to come in the door too. And so we continue to just see that play out in the real world, while the stock market world, or the narrative that was being established, I think, in public markets among short sellers, was that the product didn't work. And there was just a very big divergence in what we perceived to be the reality of this product, this technology, and the backdrop versus what the narrative was that had kind of just snowballed. And it again sort of speaks to, we were talking about the markets, this interesting dynamic that I've observed, and I've observed it in a number of other stocks, is there can be a laziness factor out there to both long and short work, where people tend to copycat or take other people's work and just blast it out, and the echo chamber grows larger and larger. In the era of Twitter and X, I think this just gets this just is exponentially happening more and more. And we certainly thought that was the case here with this company. So a lot of the social media sharing we did was simply, here's another customer spending $5 million on this product. Here's another customer expanding their existing deployment by 2 million. Isn't that strange that, amidst this backdrop of people claiming this wouldn't work or doesn't work, the customers are hand over fist just buying more and more of it. So it, for us, at the end of the day, is a unique situation of a very special technology, a very special company with huge product market fit that had a very high degree of controversy, where we were able to establish and are able to establish a high degree of conviction that short thesis is wrong.
So you get all of these boxes checked on the type of situation that you really like. Cullen, how do you think about sizing it up, managing the position over time as it appreciates?
Some of these things can become more art than science. There are rules and parameters we hold ourselves to, but also we're in the business of making the best possible risk-adjusted returns we can make. And so we're constantly assessing the information and factoring that into how we think about the portfolio. I mean, Evolve will go down as a case study in extreme conviction. I mean, from start to, it's not finished, but from the start of this investment, it was Raj discovered it was a negative enterprise value business. It had more cash than market cap. And it was a mess. It was negative gross margins. It optically looked like one of the worst businesses in the world. And it was burning cash. And so it was like, well, it's not worth anything because they're going to burn all this cash to the ground. And then kicked off a level of diligence that was, let's figure out if people like the product. Turns out they really like the product. Let's do more of those calls. Wow, they really like the product. Oh, there's this research report saying it doesn't work. What does it say? Oh, there's FOIA requests that show emails between old clients and having issues around sensitivity and throughput, and short sellers jump on that stuff. And I remember a conversation Raj had. Raj served as outsourced investor relations for the company at some point. He was fielding calls from longs and shorts about this business. And a very good short seller, pointed to this email chain from a FOIA request that showed that a customer was unhappy with the product. And Raj asked, do you know what happened after that email? And the short seller said, no, I don't. And he said, they doubled their order. They increased their Evolve units after this situation. And so pointing this to some smoking gun, the customers told you, like, you completely destroyed that thesis. And as these kept coming up, we just gained more conviction that we're right, that this business, this technology works. It's by far the best thing in the market. And then, so that goes a lot into conviction and sizing. And for us, a big position is a double-digit position, 10+% position. And Evolve, we have had at times much larger than that. It's appreciated into a much bigger position. We've had to trim it back for risk management purposes. But also, you say risk management, what does that mean? In a lot of ways, it just means that the asymmetry profile is changing. When we entered it, we thought, wow, it's real. If anything, this technology is worth something to somebody, and it'll be acquired. And then as the public markets start to more fairly value it, and hey, your downside is now more the stock could retrace for whatever reason, but the upside, we have arguably more conviction in the upside now today because we are now 3 years later from our initial investments. There's a brand new management team. They're executing very well from everything we can tell. The customer feedback remains very strong. The TAM, I mean, we just had one the other day, another shooting at a school. So the market is sadly, we think, still growing. There are still many doorways and entrances across America, across the world that need to be secured and aren't. And so we balance all of that and say, yeah, it's up a lot, but here's what it could trade for. And let's think about, what's the appropriate multiple for this business. Also, the thing we think about more these days is just the scarcity of assets in the public markets. How many businesses are there like this that are hardware and software that are growing 20+% and trading for valuation? And there's actually quite a much smaller subset these days. And back to the themes of things we've seen is, software itself has become a less desirable place to invest. All of a sudden, all the world's greatest businesses from 2021 are like uninvestable because AI might just completely obliterate their business. And it turns out maybe actually having hardware attached to your software is now a bigger moat because it's harder for AI to disintermediate that hardware layer, not the software layer. And so right now today it remains a big position for us. We have trimmed it back as it has gone up, but we still have a ton of conviction in upside in the market opportunity for this company. And at a time when they have, they are now, I don't know what, 6 months or so into a new management team executing and new board members. And we're excited about that opportunity. And, when we look back, the Evolve was a blessing and a curse in a lot of ways. It was really painful at times. We lived through 2 basically 40% drawdowns in the stock, 2 of it last year. One was an earnings miss, and then one was an accounting issue and a management change. And we added both times. And if you're honest, there are a few times when you really feel like doing that. I mean, most of the time your stock goes down 40%, you're like, shoot, I missed something. The thesis has changed, whatever it is. And so to be able to have that level of conviction, insight, which conflicts a lot of things. Look, the way that who Evolve sells to and how that becomes public record is different than a lot of companies. Also, when you deal with small cap companies, there aren't 3 or 4 business segments. There are 3 or 4 business lines, and you're trying to track what's happening in all the individual businesses. You're tracking one thing: how many Evolve units have been sold. And it turns out a lot of that makes its way into the public record if you're paying attention. And so the ability to be able to track that, at least directionally, particularly in a time of crisis and controversy in a company, which is all you really care about, is the business falling apart. And if the business isn't falling apart, then probably most of these things are fixable. And everything we could tell over the period was, despite perhaps some of the worst press you could have around a company throughout the course of 2024, with, this research report saying the business worked, then management changed and the stock price is down a ton, they continued to sell units. And so now we're on the backside of that. And, sizing through here is, again, kind of back to an art and science. The one thing you never really want to do is sell a position that's working. And, that's always kind of the first thing you want to do is it's up a lot. And the last thing I'd say on this is the advantage of a situation like Evolve, which we're always looking for, is, at the end of the day, we're playing 2 things. One is a re-rating of the business, and then get to, okay, is this from after re-rating happens, is this actually business you continue to own because it can compound at very high rates of returns? And Evolve offered both of those. And we feel like we got a nice chunk of the re-rating to here. And now it's more about how fast is this business going to grow and is it going to surpass expectations? And we're still excited about that.
I think one of the other things I'd add to this dynamic that I think is, I hesitate to say advice because I feel like I should never give advice to anybody, but, at risk of sounding strong, advice to anybody who's listening to this, who's a public company executive or board member, is there's a lot of focus on shorts, often. Like the shorts are trying to kill us. The shorts are out there spreading lies, blah, blah, blah. And I will hand it to this board and this company in particular and to some of the investors as well, people need to back up and remember that the only guaranteed buyer of your stock, is just short seller. They will at some point in the future need to be buyers of your stock. So it is incumbent upon you to make sure that they buy it at a level that's higher than where it is today. And so people should, in a lot of ways, embrace short selling. It adds a lot of value to markets. It can lead to transparency. There's a lot of scummy, shitty things that happen with it too. And we see a lot of that as well. But it does lead to perhaps some very good outcomes, that the fundamentals of your business are sound. If you're allocating capital the right way, if your narrative is good, if all of those things are the right way, the presence of those, individuals or those organizations in the market can be quite good for a functioning capital markets system.
So you're saying don't go full carp?
Don't go full carp. Unless you're carp. It's working out for carp. So
unless you're carp. But
go full carp. Yeah.
We can't all be carp though, right? So look, you brought up this great phrase here, crisis and controversy. What does it look like when crisis and controversy is no longer part of the stock?
Crisis, you could argue, like what's happening at the company level. Controversy, you could argue, is the stock level. So I don't know which one is easier to peel apart. The stock level is probably pretty straightforward in a business like this, which is us and literally everybody else who's probably invested in software at some point in their life has stared at a scatter of, here are software businesses, and here is their EV to sales or EV to gross profit, and here's their growth rate. And like that scatter is directionally correct. It tends to have a well-fitted regression line. There are always outliers on it, both things that trade for crazy valuations despite the same growth rate of a different software business, and then those that trade way off the line below where, wow, I'm buying a thing that trades for 2 or 3 times sales and it's growing 30%. And most businesses like this trade for 8 or 9 times sales. And so just watching a stock move into, hey, it's now kind of fits on the line a lot better, you could argue, okay, well, that's the controversy resolving itself. Short interest is obviously another indicator of controversy. There was a lot of short covering and Evolve. It's probably still, I'd say, relatively on the higher end of shorted stocks, because I think there's still always going to be, and probably now that the stock is up a lot, a bunch of people coming back to say, oh, this crappy SPAC is up a lot. So like, let me go look at it. And is this hardware differentiated? And like, I read this, they're like, it'll serve as all the same things. Stock's up a lot now. So people come back, it'll end up on a short screen. And many people probably go through the same exercise they went through in 2023, which was like, I read this research report that says that this technology doesn't work. So I think for a business like Evolve, who knows, maybe there always will be some amount of controversy around it, just given the technology and given the price point compared to competition. It's much more expensive equipment. There is another solution out there that we believe is a vastly inferior product, but is much cheaper. And so you always have to look at it as a source of competition.
Right. Is that really the type of thing you want to cheap out on though?
That's exactly the right question. And what's interesting is you go in, the people who make that purchasing decision on the basis of price usually don't like answering that question. They'll defer because it's exactly the right question to be asking. Is that the thing you want to gamble on?
Yeah. And we asked that question. I mean, we've asked that question 9 ways from Sunday. Why wouldn't you buy the other one? What is wrong about it? When do you buy, et cetera? And at the end of the day, and we got lots of questions on that along the way. And the other day was like, look, if it's a 2-player market, that's an incredible outcome for Evolve. There are very few businesses out there where it's literally like one company that has 80% market share. This will likely result in other players, but the market is growing, sadly. And that's the tailwind. So that's the controversy, which will probably ebb and flow. In the crisis, we think is more monitoring the company. And look, when you carry a very large position size, it is incumbent upon you to do as much work as you possibly can to make sure you understand the issues. And when it comes to understanding something like Evolve and what has happened, what's happened to the sales force, what happened to the channel, how are people responding to the new CEO? Raj has developed an incredible network of former Evolve employees, and they went through a large riff along the way. So there were more and more former Evolve. And it's actually surprising how many people used to work at the company and got laid off or left who are still incredibly bullish around Evolve and the mission it serves and their belief that this thing saved lives full stop. What else do we need to talk about? And so watching the signposts, and now we're, kind of 2 quarters into the new management team, executing, and it's going well. And so the crisis in the business we think, has subsided. You could argue it was never fully crisis, but some more kind of like self-inflicted pain they brought on themselves. The units always sold well. It was more as a question like, is this company living up to its potential? And we now feel like it's actually more on the case of it's starting to really live up to its potential.
One of the nice things about this job is to have precedents or analogs that you can look to. And look, I think some people get creative sometimes and draw pretty big parallels to things that are not necessarily parallels. I think in our case, in researching this industry or businesses that look like this, we tended to keep coming back to Axon. And Axon is one of the single best equity stories, I think, probably of the last decade in terms of the return profile, but also in terms of this question of crisis and controversy. I mean, company used to be called Taser, and they were sued every day for potentially killing people for all kinds of issues. It was never not controversial, that company. And the entirety of its time as the stock kept going up, it screened expensive and it looked expensive. So you had short sellers the whole time saying, wow, there's a lot of criticism of this product and this company. This does not look good. And by the way, it's also expensive. This is a layup as a short. And I think it's probably pretty safe to say for those people who own Axon stock, we don't in any of our strategies, but those people who own Axon stock can probably at this point run a victory lap around weathering a lot of that crisis and controversy and contending with what at the time was perceived to be a high valuation, which I think the company's obviously grown into.
It's kind of ironic that you guys went down the former route, because I think that is one of the things that short sellers do really well. Formers are not considered MNPI, like regardless of how high up the person was. Once you become a former, you're free range. So it's kind of funny that you kind of beat them at their own game on that one.
I've always thought this about expert network calls, and I've been doing this. Cullen and I have each been doing this well over a decade, and expert networks have almost always been part of the process at various stages. I think it's very interesting now in the era of transcribed expert network calls to see the degree to which there can be bias in the way questions are asked of experts. And so I have no trouble believing that in a lot of these calls or contacts with formers, that people who have a short bias against a certain company. I mean, I've seen it in other companies and reviewing other transcripts, the way in which those questions are phrased, they can be very leading. And I think this one in particular lends itself well to asking very leading questions about it.
We have a whole side podcast around expert networks and how questions are asked and why people respond to them the way they do and how much of it is purely just made up, on the fly.
Well, maybe if we can get one of those expert networks to sponsor us, we can do that episode with you guys. But look, I want to wrap it up here. You guys have already given me so much time. Is there anything else that you want to discuss or, just put a bow on some of those other topics we talked about earlier?
Bring it back to kind of what we said at the beginning. We are finding plenty of interesting things to look at today. Most of them aren't investable by the time we get through the diligence process, but we only need 1 or 2 a year to make it work in our portfolio. And so obviously there's a lot going on high level in the capital markets, and it's starting to feel frothy. We will see how that ultimately plays out. Do we get 300 plus, 500 plus newly public companies? Do we just do a whole rinse and repeat of what happened a few years ago? That is certainly the path forward. But if that doesn't come, we look for interesting opportunities for quality businesses where there's some level of change. And the nice thing about that, it being the mandate, is something's always changing somewhere. You just got to figure out where that is and whether it's investable. We are not thematic investors, and that's your questions around why we look at things or pay attention to things. If anything, it's more, as Raj said, it's more brain damage than it's worth. We tend to look for idiosyncratic opportunities, and our challenge is actually just surfacing them, because you aren't always just looking at the same set of companies. You aren't always we're not chasing down a nuclear theme and then saying, hey, what's the best nuclear company to buy? You just go on Twitter. In fact, we probably should have a side business that's just tracking on Twitter, doing whatever it is. It seems to work pretty well, maybe easier than what we do. But we are looking for idiosyncratic opportunities within a relatively defined universe, excluding some certain sectors and in a certain market cap range we're looking at. But really what it needs to feature is, at the end of the day, some level of change, a confluence of a good or very good business and a high level of misunderstanding. And I think and it's shocking us that we're still finding things that we found in 2022 still surface up these days in 2025. And if we got the big capital markets event cycle going again, that'd be great for us. But otherwise we'll just keep looking around, and that job itself is getting more efficient as we talk about with AI tools and being able to surface these things in a more timely manner.
Well, gentlemen, thank you so much for doing this. And I use this term as a term of endearment. It's always fun to talk with small cap investors, stock nerds. We did another recording talking about your business, Stoic Point, for people like me who are nerds about the hedge fund industry. So for all of you who have listened to OPM who are hedge fund nerds, stick around. Coming up next is that section where we talk about Stoic Point and the great business that you all have built. Before we go back to the beginning, why don't we talk about where we are today? What is the current state of things at Stoic Point?
So Stoic Point, as you said, is long-short investment firm. We have 2 funds and a few SMAs, and collectively we oversee over $100 million today. And our focus is really on small caps, mostly North America. And we take both the long-short fund and the long fund are concentrated long portfolios. And we focus particularly on interesting small cap opportunities where we see lots of opportunities for change.
Okay. And did you both come from a small cap background?
No, actually, it's funny. We both started out, I can speak for myself, Cullen can speak for himself too, but generally very parallel paths in oddly coincidental fashion. We both started out focusing on sort of large and mega cap companies. I started my career at a firm in New York called Highline Capital as a $2 billion fund. Not as concentrated as certainly as we are, but mostly focused on large cap. And I like that progression because I think you learn a lot about what makes for, generally speaking, and obviously this is a generalization, larger market cap companies tend to be higher quality. They tend to be more, better public facing companies. And so you learn a lot about what that's like before you kind of go into the wild west of small cap companies that have, I think, a bit more variety.
I started my career at a activist fund and was there for 6 years called Relational Investors. Sadly, doesn't exist anymore. As in fact, I think everything on my resume doesn't exist anymore besides for Stoic Point. And I did that largely focused on large cap and then mid cap toward the end of my time there. And then it worked at 2 other funds prior to starting Stoic Point with Raj, where we were probably more focused on mid and large cap, but had been on this trajectory towards more focus on the more interesting stuff going on in the small cap world, which is really everything we do today.
Look, every small cap manager says it's more interesting, there's more opportunity, but everybody kind of has a different flavor as to why. Why do you like small caps?
I think because we like to just bang our head against the wall for a long period of time and suffer a lot of pain and anguish when you could just buy any large cap tech company and not have to do much. We find it, coming from a world of spending a lot of time doing that and running a lot of scenarios, looking at a lot of downside and upside cases and thinking about return profiles, we just had found when we go into this universe, there are a lot more opportunities where we feel like we can make a lot of money on the upside and hopefully not lose much if we're wrong. And then be able to also specifically point to what seem like valid reasons as to why those opportunities exist. When you talk about that in the large cap space, it's really hard to justify why it is you think that the market has mispriced it, but it's easier to see and probably easier to believe in small cap. And the challenge there is you find somebody else who's going to care about that idea, which is probably the biggest challenge for small cap investors is even if you're right, nobody necessarily has to care. And if people care about these securities, it feels like every day.
Yeah, you just hate passive price insensitive flows. Would never take that tail.
That's right. I think it's also just easier to look yourself in the mirror and pencil out an 80%, upside case in the base case in a small cap security versus trying to convince yourself and somebody else in a $30 billion company that you're going to make 80% over the next, 1 to 2 years.
Yeah, that whole trees don't grow to the sky idea.
Yeah.
But let's go back a little bit to before you founded Stoic Point. You two met working at another fund that, as Cullen mentioned, does not exist anymore. So, what did that fund look like, and why doesn't it exist today?
So Cullen and I met working in a fund called Stillwater Investment Management, which was founded, and we were day one co-founders of that, along with the CIO who founded it. His name's Adam Weiss. He had co-run and co-founded a $7 billion fund, which was, again, concentrated long-short investing. And he had retired and decided to come out of retirement to run kind of what he had been doing before in a smaller with a smaller team. And that appealed a lot to Cullen and I. We're both process-oriented investors, and people who know his old fund, Scout Capital, know a lot about the reputation for process there and the investment principles there. Given his reputation and what he had done, I think we all expected collectively to launch with a lot more. And I mean, the short story of why it's not around today really has to do with, I think, probably a lot of what we'll spend some time on today, which is the operations of running a fund. And in the case of Stillwater, I think given that we had expected to have a lot more capital at launch, the back office was gold plated and it was built out. It outnumbered in terms of bodies. It outnumbered the front office on the research side. And that burn rate after a while with, not scaling as much, and we still launched with and ran a decent amount of capital, but a lot of that was the founder's capital. Things were humming along in the research process. I think it's escaping that burn rate is a struggle. And eventually I think that was a big contributor to why Adam decided to retire again. But it is also a big contributor to, I think, the success of Stoic Point and the origin story of why Cullen and I decided to partner together after kind of getting that sudden kick in the stomach.
So the gold-plated service providers and back office, was that something that you all thought was going to attract capital, or did you think it was necessary? How did that decision-making process go?
I think the gold-plated nature of the operations and back office at the fund we met at was really by virtue of the fact that the founder had run a $7 billion fund prior to that. And I think when you're running a fund at that scale, it's necessary to have multiple primes, gold-plated fund administrators, both internal and outsourced counsel, multiple traders, a very deep back office team, despite the fact that, again, you're running a concentrated portfolio with pretty low turnover. So I think that was necessary and sort of table stakes for having a large institutional fund at the outset. And really the problem was that sort of top line didn't meet what we had at the operating cost structure level. And it informed a lot of, how Cullen and I decided after Stillwater closed, how we wanted to architect Stoic Point. And it also explained why we didn't sort of just roll into it a week or two or month or two later. We gave a lot of thought to what do we learn that's good or bad about, the operation, this sort of the small business side of running a fund when we decided to launch.
Okay. So yeah, what did that conversation look like? The fund has decided to close. You guys are, sitting around saying, what are we going to do next? How quickly did it move from what are we going to do to obviously we're working together and we're going to start something?
Yeah. We met for lunch in downtown Palo Alto about 2 days after Adam let us know that he was going to close Stillwater. And Raj and I kind of, we joke was like a rom-com. We pitched each other on the same idea and interrupting each other that despite the fact that in late 2017 in downtown Palo Alto, we could have thrown a rock in any direction and broken the window of like a future unicorn and probably should just gone to work there. We decided to start a long short hedge fund, which is, like a dying industry, and then ultimately ending up in small cap investing, which is like a dying part of a dying industry. And so we really, I think it was two things. We clearly wanted to do this was our objective, to be able to find interesting public markets opportunities. And I think the second most important thing is we had just spent 3 years together and came to realize that we really enjoyed working together. And it's actually pretty rare, I think, particularly in this industry, to find people you really want to work with closely in a high stress environment. Not only were are we doing public markets investing, which is high stress enough, but we also had a startup. So it's amping up all of that. And so it was pretty quick in terms of the decision to move forward. I think by, a month or so later, we were laying the groundwork and really starting to dig into what does it mean to start a hedge fund. We had been there for the launch of a hedge fund, but as Raj mentioned, research and operations are two very different things. And we were hired to do research. We had a back office team to help with the launch and laying all the groundwork there. And so, yes, we were in meetings around that and observing things, but we weren't actually doing that as part of our day-to-day job. And so we were spending a lot of time then over the next really 6 months. It took us probably door to door almost 9 months before we decided to officially open the doors and launch the portfolio of trying to figure out how can you do this most efficiently? What are the trade-offs you need to make? What do we need to understand about running a fund on a day-to-day basis? And so it was a lot of that was doing what we do as analysts, which is a bunch of research, asking a bunch of questions, reviewing our notes, asking follow-up questions. And that took a while.
It's funny. We launched with just, $2-3 million at the outset. And it's not a lot of capital to start a hedge fund with, but I do consider us to be very lucky. Yes, we didn't get sort of outside, our old founder didn't contribute a bunch of capital or anything. He's never invested in an outside manager, but what we did have, in place, which is the solid sort of rock foundation of Stoic Point, is our process, our investment philosophy. Cullen and I already had that from having worked together for several years before. And funny, when I look around the industry, we know a lot of people who start funds together with somebody else they've met it and you become friends with, and they see each other on the conference circuit, pitch each other ideas, and they're like, great, we should go into business together. Like, we see eye to eye. And I liken it a lot to kind of rooming or moving in with one of your friends. You guys are great, love hanging out, doing stuff. And then you move in and you realize like one of you is just a slob and it's awful. And being roommates is terrible. Whereas it would be much better to become friends with someone you were already rooming with. You kind of already know a lot about each other, the important stuff. And then, the friendship comes later. And so I think we were very fortunate in that, because we were able to spend that incremental time between the close of one fund and then going into business together, really focused on that core operational stuff. And we didn't have to worry about what are our investment principles, what are the things we're looking for in the portfolio, how do we want the portfolio to look, and so forth.
Yeah. So what were the resources that you went to? Because there's not a lot out there about how to start a hedge fund. Ted Seides has written a book. I think that's maybe the only one.
Yeah, I think one is we called a bunch of people or got introduced to people who had started hedge funds. And, I think there's some amount of, feels like sometimes there's secrecy in the industry, or, maybe it's the difference of being on the West Coast versus the East Coast, but we actually found a lot of people who had started hedge funds who were willing to talk and share their experiences and answer what we thought were stupid questions. And they're like, I had the same stupid question when I started because I had never thought about a trade break in my life and what that meant. And so a part of that was just having our personal network and then getting introduced to somebody. I mean, another resource to lean on when you do this is the prime brokers. You have a bunch of conversations with primes, and either their salespeople or the business operations consultant at the prime has been through this 1,000 times, and not for anything, where there's no shortage of hedge funds, despite how terrible the industry it is. And so they've been through this many times, and they know all the service providers, and they know who to connect you with. And I think a learning for us was it can seem overwhelming because hedge funds come in so many shapes and sizes, and there can be so many layers and a lot of complexity involved, that the answers you get off the bat end up like making no sense to you almost. Like, why would I need that? And what would that be for? And then they kind of step back and say, well, okay, how many trades are you doing? And what's the portfolio look like? And it's quick, like, oh, actually, well, you probably don't need that middle office solution. And so I think we got good direction. Our first fund, Wells Fargo, was the prime, and they were great. They answered a lot of our questions. And that was after interviewing probably, 3 or 4 primes, and we decided to go with Wells. And then we got introduced to Constellation, who had actually been our outsourced CFO, is now part of IQEQ, but they were a resource to lean on. Obviously, they see a lot of hedge funds. And so just understanding, here's what you need from a back office. Now, I will say, in retrospect, we get into this. I think we got oversold on a lot of things that took us some time to unwind across the board. But the resources are there. You ask around and you'll get to the right answers. I think my advice looking back, part of it is just, have your first principles, know what it is you're trying to do, and think through just logistically, what does that mean? And then make sure when you get to answer these questions, someone's answering your specific fund structure in your specific day-to-day, before you go down the path of, I'll take a middle office solution and I'll take a second prime or whatever it might be.
Now, what about the economic calculus of it? You knew you were launching with $3 million. Obviously, the gold-plated back office was not part of the plan. But even still, even if you go bare bones, it's still expensive. It's still unlikely that you're going to be, profitable, especially at the management company level in day one. So how did you do the math on what the burn was going to look like and how long you had to stick it out and make this go?
Yeah, look, I think you're absolutely right. And this is the adjustment that I think a lot of people in this industry need to be prepared for. You're leaving something where you had a steady income and potentially a lot of upside and some good income earning years to going to not only not just making money, but losing money at the outset. And you are writing checks into this business. I think the number one thing we leaned on, and this bears mentioning, is our wives. Like, this isn't just like advice for how to launch a hedge fund. This is life advice. Marry well. Our wives were supportive of us from the beginning in terms of spirit and enabling us to do this and take a big risk to do it. Our wives also had healthcare coverage, at their jobs, which is a big expense, obviously, when you have kids and when you're working for yourselves. And so they were not only supporting us emotionally and being willing to ride this out with us, but also being willing to, lend, thankfully we've joked that Mark Zuckerberg is like the hidden investor in our fund because both of our wives work at Meta and have worked there for almost a decade or over a decade each. And so that stability, it really did give us a lot of comfort, despite the fact that we were losing money and the economics of this business. And I think, the other thing to be transparent in those conversations with those service providers about is exactly that. You say, look, we're launching here. This is a partnership. You're partnering with us. I understand that that's your price list. Here's literally what I can afford because this is what we're going to be running with for the time being. And our hope is to grow and your hope is for us to grow. And so let's grow together. And, surprisingly, perhaps not surprisingly, the vast, vast majority of service providers, they get it. And they want to be there for your success. They want to be levered to your success as well. So they will play ball at the outset. And so doing those types of things, I think, really helps. For us, the strategy is concentrated. Cullen and I really enjoy being not only portfolio managers, but analysts too. It doesn't require us to have an army of analysts. We don't have to manage 100 names, and everybody has their own strategies. So that enabled us to be a bit more tight and lean on the resources piece. We don't have aspirations for this incredible office, or we need an admin to answer the phone, or some of these other things that we were used to from our prior funds. And working without those things and learning to be scrappy is really good. I think we also, one other thing, and maybe this is a luck or a function of it, but I think it would also apply to anybody who does this today, is on the research front, going to those service providers and saying, look, I can't offer you a lot of money right now as a client, but what I can offer you is a ton of feedback and value. And so we were very early clients of Tegas, of Sentio, which is now AlphaSense, which is also merged with Tegas. It's just like everybody's merged in this industry. But we were able to offer them early on, look, we're going to give you a bunch of feedback about this product that you're iterating on. We'll do a lot of calls. We'll generate a lot of content for you. And we're always available and we're always willing to experiment. Use us as guinea pigs. We did the same thing with our RMS provider. We've done the same thing with a number of things. We actually still do it today. Anybody who comes with us, and we'll talk about AI, I'm sure, but anyone who comes with us with a new solution, we're like, hey, that's great. We're not going to pay you a lot of money for it right now, but we will guinea pig the hell out of it. And that'll be of value to you.
How do you bridge that conversation? Obviously, every single person in this industry fancies himself to be like some sort of master negotiator, right? And I have certainly been on the other side of people where it's like, man, these people are just cheap. Like, I know what your AUM is. Like, I've looked at your 13F earlier and you're trying to nickel and dime me for like a couple grand. Like, how do you make sure you're not coming off like that?
I mean, I'd say we're probably in the like, man, these guys are cheap. They really hammer us on pricing. Look, I mean, look, we deal with it all the time. It's part of being in a competitive industry. We're an extremely competitive industry. We are getting hammered on fees all the time in every negotiation. Everybody wants a deal. And if you are asking for a deal, you're not doing your job. Because I think the fallacy of this industry, and all asset management, privates included, is that fund expenses aren't borne by the management company. So it's actually passed through to investors. So yes, you should be diligent, and yes, you should try to get a better deal. But a lot of these, what's your admin? What is legal costs? Why did this bill come through? Et cetera, even research. All of that is ultimately only a portion of it is really borne by the manager. And I think one, because Raj and I are inherently cheap, but two, for many years in fact, even I think this year, we may end up reimbursing the funds for some overage. We have caps on our fund expenses, and which is a challenge of launching a small fund, which is all the stuff you got to pay for. And if you run it all through the fund, then your fee burden is going to be 250 basis points and way out of market. And maybe people won't realize it, but I think they'll ultimately figure it out. And so we put a hard cap to make sure we didn't spend more than, I think the original cap was 60 basis points of fund expenses on our original fund, which started with $3 million. So that's not a lot of money to go around. And so it was actually Raj and I reimbursing the funds for fund expenses. And that mindset is like, this is my money. This is 100% my money. So no, I don't think your service is worth that much. And it's going to come out of our pocket. And I think when you tell service providers, service partners, even try to use language like they are partners, they're not just providers or something, that this is coming out of our pocket, and I think that attitude actually inherently changes something about the conversation. And my advice to anybody is every number is negotiable, and maybe they won't budge, but then if it doesn't work in your budget, then look for alternatives.
Was that something that somebody gave to you and said, hey, you really shouldn't be passing through more than 50 basis points? And then is that an ideological thing, or is that in the fund docs? Like you have strict rules on what you can pass through?
It's in the fund docs. It was in our fund docs. I think that actually the advice on this was mixed at the start. I think some people said, just be careful. You don't want to have a number that's too high. And but Raj and I making sure we kept the burden on our investors as low as we could manage and still be able to try to launch a business. We picked that number. I think the number could have been 100 basis points or higher than there could have been no cap. And the advice actually was mixed, and it's kind of up to the management to decide what they want to do within the realm of you've got to be competitive.
I think on the flip side too, we have for those early investors, which look, by and large, were like people Cullen and I have worked for or friends and family. That fund expense cap is important. And then it's also on the flip side important to reward them on the backside. So the management fees for that class of investors, for the founder class of investors in our funds, goes to zero over time too, because we don't want to be on the backside with managing, now more than 100 million of AUM, collecting a lot off of the fees. So at certain thresholds, we have step downs in management fees, which will go all the way to zero as time goes on.
I want to talk about the sort of marketplace for your fund at the time that you launched and what you learned about where you sat in the marketplace, because it's all well and good to say, this is the strategy we like. This is where we think the opportunity set is, but you are in the supermarket of investment products and somebody has to want to take you off the shelf. So what was the strategy that you went out with and what was the reception?
Yeah, supermarket's good analogy. Raj likes to say Cheesecake Factory. We're just one of 100 menu items. We went out with what we thought was a great form of investing, great structure, something we had been doing for the last 3 years together, which was moderate net long, concentrated, 10 to 15 longs, maybe 30 or so shorts, and targeting a wide range, but 40 to 60 net, but the ability to go up and down outside of that range if we felt like it. And it was technically kind of all cap out of the gates. The trajectory we had been on at our last fund and what we thought were the more interesting opportunities was moving down market cap spectrum. Obviously, we'd come from a fund that was even bigger, though we could have done anything. But we stuck to those parameters as, hey, this is what we're doing. We felt like it had been working for the two of us. We had a process built around that. We saw a lot of opportunities. And it was also a good maybe the best marketing story, in potential clients, particularly in the institutional world, are looking for some narrative that makes sense. These guys were working together and they're going to do the same thing. They're losing Adam and a couple other research team members, but for the life of Stillwater, it was really Raj and I working closely with Adam. So that was the idea. Hey, we're going to try to do this on our own. And so that was it. We debated at the outset, should we bother shorting stocks? Even in 2017, 2018, it was already kind of like, who needs to short? The S&P goes up 16% a year. Like, why would you bother shorting anything? And funny, Mirage and I, in 2018, were like, wow, there seems like a lot of short. It's kind of crazy around here. Palo Alto, it seems a bit frothy. We were like 3 or 4 years early on that call. And we're already back again. So maybe it's never not frothy, but we thought there was going to be a lot of short opportunities. We liked being, having the ability to short. We can talk about that more, but just having the mentality and the mindset to also be shorting stocks. So the original fund was a long short, modern net, and, a broad range. We were doing some large cap, or our large portfolio had some large cap in it, but it was probably a bit more weighted to mid cap. And we got out there to talk about that. And we did a whole lot of meetings and got a lot of people who said, that's really interesting. Put us on your distribution list and let's stay in touch. And that's the first 4 years of Stoic Point, basically.
So when you say people said, that's nice, put me on your distribution list, I feel like everybody gets that. When you hear that, how do you translate it now?
Yeah, it's funny because you still get the put me on your distribution list. That sounds really interesting, and I'll follow up. Once we've discussed internally, and I think Cullen too. We got married just before dating apps became like popular, but I feel like there's a dating app equivalent of that somewhere where you're just like, you go on that first date and you're like, I don't know, whatever, like maybe. And so you still get that. Well, I mean, what it means to us is, it's funny. There's a parallel between how funds work when we meet, investors work when we meet with companies, and then we go back to our offices and we have to pitch our portfolio managers on an investment. And allocation, my understanding of it now, as we've grown to spend more time with allocators, when we didn't have this understanding of their business, which is shame on us. We didn't start out that way, understanding what allocators need and what they're looking for, but now we have an appreciation for it. The parallels to our business are that you need a story to sell. There needs to be a narrative to sell. You are ultimately pitching this to somebody else you work with or work for. And in those meetings, I think you're either coming away, or they're either coming away thinking, okay, there's something here that is going to be attractive to the person I work for that I want to pitch them, or there's something that's not. And maybe this is interesting, but it's not interesting to me right now, given what we need or where the fit is. And a lot of times it's the latter. It's just, they are looking for something very specific. The conversations that I think we enjoy, of the subset where it doesn't end up converting to that person becoming an LP in the fund, are the ones where they're very transparent with us, either at the front or at the back end of the conversation, to say, look, we really right now are looking for, we had somebody tell us this a couple months ago, we're really looking for somebody who's doing something in energy. That's just a hole in our portfolio. For whatever reason, we feel like we need that. Well, Stoic Point doesn't do anything in energy or in healthcare. Those are the two areas that we just don't think we're ever going to be the smartest in the room on. So we tend to avoid those industries. And so they're very upfront with us. We're very upfront with them that doesn't make sense. That said, they've kept in close touch with us because that's just their need at this time now. Down the road, they may have a need for somebody who has a wider mandate in terms of the sectors they focus on, in which case, we're perfect. Because what they do like about us is our focus on change moments and the fact that our portfolio has very low correlation to the other stuff that they may be invested in, even within small caps. And so they want to stay in touch. But those are the helpful ones, so those, you get those disappointing points of feedback, or lack of feedback from allocators, which is just keep me on your distribution. I don't think to date, I mean, I could probably count them on one hand, and our CRM is probably 300 plus names deep, where the monthly goes out, and then we've had someone who we haven't talked to in a long time sort of email or reply back to the monthly, like, hey guys, it's been a while, we should catch up. Like, that just doesn't tend to happen. We had it's one of our close partnerships, one of our investors show us at one point during lunch, I think it was last year, he slid his phone across the table and he's like, I just want you to look at what my inbox looks like. And it was just tear sheet after tear sheet and monthly distribution after monthly distribution. And this was a guy who was running a family office effectively, not an endowment, not probably someone who's getting like 10 times that. And he's just like, I have to filter through all of this all the time. So if he's been on somebody's list for 3 years, it's not likely that something's going to click in his mind when he opens that sheet, when he's sitting on the toilet and he's like, oh, wow, something's different here at this point. I should reach back out to these people. It's incumbent upon us probably to remember what they were looking for, what their value set is, and then reach out to them when there's alignment.
There's two sides to that the outreach part, keeping track of those moments when alignment might come to be, and whether that's noticing from trade publications that so-and-so is making allocations again, or obviously, just the environment has shifted for attitudes towards small caps or whatever it may be. The other side is disqualifying people and moving them into the no category. So you don't have this glimmer of hope in the back of your mind about them. And you have a false sense of security and, oh, well, we're putting out the monthly, we've got all these prospects. How have you gotten better at sort of forcing people to show their cards a little bit?
I don't know if we have gotten better at that. I think maybe we've gotten more direct and blunt to ask for some form of indication. Is this at all interesting, or should we just move on with our lives? The reality is very few people are going to tell you like, I hate you, don't talk to me ever again. I think our conversations are always good enough and interesting enough that people want to hear what's going on. I think you do get a sense, and you should get a sense for looking for investors who you think are going to be good investors for you and for what you do. And, now in particular today, Raj and I run a strategy that's pretty volatile. It is small cap, wonky securities. Some of them are not liquid. So month to month can be some big moves. And annually can be some big moves. And the partners come in all shapes and sizes in terms of their willingness to absorb that and want to talk about it and understand why you're down, the amount you're down or whatever it is. And so I think you can suss that out somewhat. And if you really get to the point of like, we're just not going to. I mean, some of this is pretty easy because even people who take a meeting about your hedge fund and then they say that, well, really, we're looking for very low net, diversified healthcare, whatever it is. I think those are the ones where it just feels like there's never going to be alignment. The thing you are looking, here is our niche product, and that is not anywhere close to the niche product you're looking for, then there's just probably no sense in us having a follow-up conversation. But those are actually pretty rare. I think most of the time you end up in no man's land. Okay, sounds cool. If there's advice in there, Raj and I are constantly struggling with this. And Raj is probably so annoyed by me because I would wake up in any given month and say, we should do more marketing. And then the next month I'll be like, we should do no marketing. Why don't we just find a good idea and go back to our existing investors? Cause I think there's enough capital there and they trust us that like, why would we bother? That's the easiest form of marketing of all time. It's just go to your existing investors and say, I have something really exciting to do. Do you want to participate? And if you've made them money, your odds of closing them is much better than closing anybody else. But that, whatever mania shows up in the fact that we don't do a good job of staying in front of our own CRM in terms of having quarterly follow-ups with them, sending them something interesting that we send them our letters, but our letters come out twice a year and they're long. Probably people read about half of them and then read another hedge fund letter. It sounds very similar. And so I think you really need to commit to, I'm going to stay in front of these people and talk to them about interesting things and get a lot of touch points. So then I'm top of mind when they are thinking about allocations. And we're not good at that. We never have been. We probably should be better, but then we get distracted by doing our job, which is finding interesting investment ideas.
Yeah. To the letter length, Institutional Investor did a survey of their readers and I think the data came back that it was like 80% of people wanted written communications. They didn't want you to send them a podcast or a video or anything like that. They wanted written communications. And of that 80%, like another 80% said they wanted to be less than 6 pages. So that, and I don't trust me on that data. You can find the article.
No, I believe it.
They're out there, but it's very interesting. And I cite it all the time when I'm looking at letters, like 6 pages. Nothing more. But obviously the strategy has morphed somewhat. You still run the strategy that you have at launch, but around 2021, you saw something in the market and you said, this is where we want to be right now. Talk to me about that period of time, and then we can get into how that started to change the tone of conversations with investors.
In some ways, everything has changed, and in some ways, nothing has changed. We still do the same thing we did at the start, which is take our investment principles, we have 3 of them, and apply them in a process that Raj and I have been now working with for 10 plus years, to go out and find interesting ideas. Find particularly interesting ideas where we think there's really good upside and less downside, and they're ace bet. What is more is where we spend our time, and to some extent, what the type of idea ultimately looks like. And that was really driven by a couple of things. One, just we were on this evolution to, hey, let's spend all of our time really in mid cap. And then it was like, should we even be bothering with a $15 billion company? Like maybe sub 10, maybe it's sub 5. And then in 2020, late 2020, Chamath and Co. and everybody got out there, and the SPAC thing came roaring back. And we've looked at SPACs. We had been invested in some de-SPACs at Stoic Point and other times of our career. So it wasn't foreign to us, but the resurgence, the rise of this in terms of the amount of capital, the flow of deals, it was becoming a real asset class within the public markets. And there was some wonky stuff going on. There was just too much happening too fast. Retail was involved, momentum was involved, and you had these warrants trading out there. And now there were suddenly hundreds of these warrants trading with tens of millions of dollars market cap behind them on each one. And we were seeing some really interesting opportunities in our long-short fund to take advantage of this craziness and use these warrants as a way to get involved in some of these sorts, particularly on the short side, but hedging out a lot of the risk using the warrants. And we started to spend more and more time on these deals. We were looking at every deal that was going public because we said, look, there was a lot of interest in new issuance in general. There are a lot of IPOs. We weren't going to get allocations to the IPOs. And we were then starting to see, and people were still kind of ignoring SPACs as it's a lot of retail, it's still these kind of like oddball companies. But then you started to see real sponsors and real companies who otherwise could have gone public in a regular IPO were choosing the SPAC. And so we were looking at every deal going public and trying to suss out what was interesting. And we had said this from the start, this is a phenomenal long short universe. There will be some great longs and there will be a lot of great shorts, but there's going to be a very high dispersion of returns. And we got introduced to an outsourced CIO and started talking about some of these trades we were doing, and they got really interested in it. And then we did a deep dive with them. We were on the phone with them for hours, multiple times, walking through the structures of these trades, what we were doing, what we were saying. And they got really excited about it. And so we set up a separate vehicle to take advantage of that. And it launched in May of 2021. And the idea was there's stuff going on here. There's going to be more stuff happening. We'll figure out a way to make money doing it. And that, to tie it back to running a business, and since then, we have continued to focus heavily on the SPAC market, the de-SPACs. Everyone told us in 2022 it was over, never come back. It's dead. They ruined it all. And here we're back again. Chamath is, listed as his next vehicle. So we're doing it all again. Maybe not quite the frenzy we've seen, but it's only August. We'll see, give us another 6 months and 300 basis points of rate cuts and we'll see what happens. But we've been steeped in this universe and that's not everything we do, but it became the observation that this is the purest form of the things we are looking for. There is so much misunderstanding around these opportunities, these orphaned public companies. There's shareholder rotation. There's management change. There's board change. There's all these things. And these are all things that have always been our misunderstanding database and catalog, but to see them all, gel around one or two specific ideas. And then you do the net and you build your model and you say like, well, that's crazy. 2 things go right, and this trades like an average company or a discount to an average company. There's like 200% upside. And if things go horribly, seems like there's asset value here. This is a real business. Somebody would acquire it, whatever it might be. And so that compared to underwriting all the normal mid cap securities you might see and doing that upside, like, it's like 60% upside and 30%, like whatever. And these were just so skewed to one direction that became really exciting focus for us. And we have since, over that period, raised a not insignificant amount of capital to do that in the best form that we think is possible. And we mentioned it, but I think the honing in to be something that is more niche, but also sounds more niche, has been a tremendous benefit to raising capital, because we're talking about one type of thing going on, one type of thing that we're looking for. And maybe it could be reflected results. Our results are, I don't know, like I said, for marketing purposes, the results are results, but it is a reflection maybe of us just finding really good ideas and people getting really excited about that. But it also is a better marketing version of anything we've ever said. And we joke about this. We get into conversations, we talk a lot about de-SPACs, and we could start the whole thing just saying what we originally said. And then at the end, like Scooby-Doo pulling off like, haha, they're all de-SPACs. Like, we got you, but we don't. And so then the narrative comes like, well, is this the only thing you guys do? And the answer is no, but it happens to be one of the more interesting things to talk about. And that's been an evolution, but really just a reflection of what's the opportunity set we found most exciting. And for a while, it's been in and around really newly issued public companies that are going through a significant change, or companies themselves. They might have been public for a while, but there's something going on and something is changing. And that's what we come to.
And tying that back to, and look, again, this point that just like investors do, allocators need to sell this internally to the people they work with. It's changed from, hey, these guys at Stoic Point do interesting things around change events with small cap companies. Okay, what does that mean? I don't know. To, hey, these guys have narrowed in and they're one of the only guys doing this around broken IPOs and de-SPACs, and they're finding the needles in the haystack among this space, and they're doing it repeatably. And that's a much easier, sexier pitch for someone to get their head wrapped around. I think the other thing that benefited us was it particularly resonated with a subset of allocators that are family offices run by retired, generally hedge fund managers, who for 20, 30 years had been running their own funds, have obviously lived through a lot of cycles, and have seen opportunities either that they seized upon or didn't and wish they had, that in some way, shape, or form sort of paralleled what we are doing now. And that just clicks for them. And those are, we've had conversations and it's crazy. We've had like 1-2 calls. We did like a follow-up, and then immediately they're like, okay, great. We're going to write the check next month. And you're like, oh my God, that was so easy. But it's just, again, it's that finding that alignment with the right investor who clicks and understands exactly what you're doing. And part of that goes into this kind of just being a numbers game. I think the other function of it was, after we got that original sort of investor that Cullen mentioned, they start making referrals to other investors. Again, very analogous to what fund managers do when we pitch every other fund manager on our portfolios. And you're like, oh, I really like this idea. They're like, hey, I really like this manager and what they're doing. And if you guys are looking for that, then you should talk to them.
That period was so crazy. And to your point, to be able to like distill it into something that they can sell quickly and easily. Like with the warrants, one of my favorite things was they're not listed on Robinhood. They can buy the equity and they can't buy the warrant. Why is the warrant so mispriced? You would think they're addicted to options. Why wouldn't they be addicted to warrants also? It's like, well, Robinhood literally does not list them to buy.
Yeah.
So and being able to say that to somebody and the bulb just goes.
It's crazy. And 10 years ago, did you ever think that would be like, does that even make sense? It's like a thing. It's amazing how quickly things change and where these change events occur, and how you can try to exploit these opportunities.
Yeah, well, which I don't know. I should probably like get on Robinhood to like see what has changed and how they like list SPACs now. Like, I don't know. Can you buy warrants on Robinhood these days? You can buy crypto.
It's still, the wonky mechanics of it too. An example that's just happened. There is a de-SPAC called Grab a Gun, sadly. And the day of the ticker change, we were watching this. Retail was very excited about the ticker change, and it was going to meme because the deal was closing. And so the ticker was changing, and then they totally lost it when it became evident that you couldn't on Robinhood, and I think a couple other kind of retail facing brokerage platforms, you couldn't buy the day of the ticker change because they were processing still the corporate action. And so then all this excitement around the day the ticker changes, the stock's going to skyrocket, and it started to sell off. And then it snowballed and the whole thing kind of imploded over the next few days. But we're still doing these same things. And that was literally just the mechanics of a ticker change and the ability to execute a trade on Robinhood. And so that was kind of like, the belief is like the stock didn't work because you couldn't buy it on Robinhood.
Yeah. But you guys could obviously trade it with your brokers, right? Like people had like a real brokerage, not a problem. So I want to talk a little bit about like the vehicles that people are coming in with. So you have obviously a new commingled vehicle for this strategy. What about SMAs? And with this class of investor, the sort of former money manager, family office, how do they like to invest?
Cullen made references before, this notion of we became increasingly self-aware that we are just one, appetizer on a Cheesecake Factory menu of options for allocators. And increasingly they can sort of choose and dictate what they want. And we have certainly noticed a trend over time that allocators, and Bloomberg's written about this. I'm sure there's lots of I'm sure II's written about this. There's just been a general trend towards institutional allocators wanting to do the SMA route for a variety of reasons. But that is certainly something we have also seen in our day-to-day as well, which is for a variety of reasons. They come to you and they say, look, I want to replicate all of your long portfolio or a subset of your long portfolio or just your top 5 positions. And we'd like to do that in an SMA type structure. And, there's always some, back and forth negotiations on what is that worth from a fees perspective? Should it be more? Should it be less? Should it be the same? But that's certainly a desire that's been expressed on the part of allocators. And our philosophy generally has been, if it doesn't introduce incremental or too much incremental complexity for us, we're fine with it. It does require, and there are things, and that's required us to accelerate sort of becoming a registered investment advisor. There are other things that you have to consider when you start taking these, and from the entities that you're taking SMA capital from, there are things you need to talk to your counsel about and figure out from a regulatory perspective, depending on even the state that you're in. But generally speaking, look, you're getting more. For us, it was a very simple question. Do we want to be longer? The things that we really think have a lot of upside? Absolutely, yes, we want to. Our largest position in our fund, we took a lot of SMA capital as well. It became very large in our fund. We were able to take additional capital, most of which was from, or a lot of which was from existing LPs, to get even longer those ideas with minimal incremental complexity for us. And so, we're still open to it, and I think allocators still ask about it. I think we're going to continue to see this as a trend out there. At the end of the day, the simplest way for us to do this is to just have LPs be LPs in the funds that we manage. I think pick your point in time, and we've done this sort of math before, and Cullen and I have looked at each other and just said, generally speaking, they'd probably have done better just being LPs in the fund. There's a benefit to having a portfolio approach, but to each their own. And like Cullen mentioned, some LPs don't really care about volatility. They care about from point A to point B, and that's really it. And so that's fine. So I expect we'll still continue to see it. We still have those conversations. I know there's some large endowments out there who that's their primary approach. Part of that is also, by the way, and I don't blame endowments for this, when they go and they approach a manager that's only managing $10 or $20 million, they want to get exposure to that manager's ideas, but they don't want to be exposed to that manager's business at the end of the day from a going concern perspective. So doing this through an SMA structure may make more sense to them. We're at a different place now, but we'll still entertain those types of conversations.
So there's like the SMA, which is a clone of your commingled strategy, which they have the transparency. They can maybe dial up, their own leverage on their end. And the other side is almost like an SPV, like co-invest type of thing that you're starting to see a lot of in the private world. So between the sort of just clone of the commingled strategy versus the co-invest model, but on the public side, is there any difference in the demand there?
We've noticed more demand for single stock ideas. That has clearly infiltrated the allocator community. Maybe it's gone really well. We find it interesting because it's like we take a lot of heat for kind of like, it's really hard to be a portfolio manager. It's really hard to be a hedge fund. It's so competitive. And where's your edge? And then it's like investors, now allocators, like, I would like your best single idea, and I can re-underwrite your best single idea, and that will be a better version of whatever it is. And there's some validity to that because look, we're not just running we're running a business, And so even if we had the greatest idea in the world, is it going to be 100% of the fund? No. And it's so I think it's happening more, and maybe it just got easier to manage this, or maybe we're just a more vulnerable, asset manager out there the irony here of, increasing SMAs in the public markets. Investors want more transparency. They want to know what's in the portfolio. They want to be able to control it. With the public markets, while on the flip side, there's obviously been like an insane amount of capital throughout the private markets where there's no transparency and nothing. You don't really know what's going on at any point. You're kind of relying on the manager to self-report their valuations. So it's just a tough part of being a public markets investor, asset manager. At the same time, we've seen less and less interest for moderate net long, moderate net exposure, long short. It's either zero net or long only. We've seen also more interest for full SMAs in the same portfolio or single stock ideas.
So as AUM grows, it tends to happen in a couple of ways, generally depending upon how much of it is compounding versus new money coming in. So it can be a nice, sloping curve that accelerates as capital starts to compound, or it can be a stair step function. So for you guys, I'm sure it's a little bit of both from depending upon what year, but when you were growing your asset base, was it more that stair step function or the smooth curve?
The short answer is it was more the stair step function. But if you were to look at that stair step, it'd be like a lot of the floor for a long, long period of time for multiple years. And then you sort of stair step. When we got into this, it's funny. This came from a few different investors, but I generally think it holds true. We kept getting told that after the 3-year mark of having sort of 3 years of track record, you would be taken a little bit more seriously. Now, by the 3-year mark for us, we had grown from obviously the 2 to 3 million that we launched with, but we hadn't grown nearly as large as we'd wanted to be. But I do think that we did start getting taken more seriously in terms of, okay, this is a representative track record. This is how they manage risk. This is what the portfolio looks like. These guys are doing it for the long term. Because let's be real, a lot of people launch a hedge fund and it doesn't go for more than 12 months after they are not used to, getting a paycheck every month. And so I understand that standpoint from the allocator perspective. For us, we had that long step. And then I think we talked a little bit about, when the SPAC opportunity came along and there was just a flood of new issuance and there was a lot to do, we had something really differentiated to offer and really differentiated to do. And I think that helped us at least get on one sort of anchor investor behind that strategy, which then, thankfully for us, they were then willing to refer us to other people and bring in some of their other investors, which again goes back to this notion of how much fundraising do you need to do with new investors versus how much do you just need to do right by your existing investors, where either they will give you more capital out of their own sleeves of capital or go and refer you to other people who they trust to come with you. And I think we had a little bit of both. Because for us, we weren't doing ourselves any favor on the fundraising side. We launched with a co-PM structure, which is awful. Like, people ask you a bunch of questions about it, which we thought was strange because we think it's actually an asset to have a co-PM there, another person you respect with decision-making authority who helps keep those emotional things that inevitably end up happening in this job in check. We named the firm Stoic Points, for that reason. But, we also don't talk about names in a very salesman-like, capacity. We tend to pitch the base case. We talk a lot about things like asymmetry, where I think some of the best fundraisers I've ever worked with just talk about the bull case, and that's it. You don't talk about anything else. It doesn't exist. There's no base case or bear case. And so, we initially got a lot of that wait and see type feedback, but then when we had something more niche-y, something more differentiated to talk about, I think it really helped. And having that sort of click, especially with this subset of really primarily like family office investors that were run by former retired money managers who saw parallels in what we were doing to things that they had done in their careers, we sort of found our fit. And look, we're still, finding that, and hopefully we branch out to even more types of LPs. But that's really been what it is. It again comes back to this is I think the fundamental recipe for success in this industry, which is just staying alive long enough until you find that right opportunity or right investor set. And for us, it took a while. It took longer than 3 years. And Cullen and I were having real conversations 3 years into it. Like, how much more runway do we have? Not from the perspective of how much cash burn capacity do we have. I think we'd gotten to a good place in terms of the operating structure, but the opportunity cost. We live in Palo Alto, and every year somebody's getting rich doing something else. And so for us, it was really a question of that. and the opportunity cost, that's balanced by the fact that we just really love what we're doing. We fundamentally think this is the best job in the world. And so how much runway can we give ourselves? And when we were fortunate to get introduced to the right investor, to be able to finally find that click in our marketing and find an opportunity set that I think really resonated with people.
Yeah. So when you find an opportunity that you like, back then it was the whole SPAC market, but sometimes it is an individual name. There are a lot of differing views on how public you can and should be with an idea that you're excited about. You are active on social media. You are comfortable talking about the names that you're excited in. So can you talk to me a little bit about your philosophy on sharing ideas publicly, whether that be an idea blog or social media or Substack? How did you get comfortable with the idea of talking about your ideas in public?
I love this question because we are super paranoid about this stuff. And I think, Max, it might have been like now 3 weeks ago or something. I think you put a thread up there in response to, maybe it was the Open Door guy. I'm forgetting
The
now.
Open Door guy, or
Yeah,
I guess
he's the Open Door
he
guy.
calls himself the Carvana guy.
Yeah, he calls himself the
Just random-
Carvana guy. And I'm like, I don't know, but there's another Carvana guy out there. I'm not sure if
Yeah,
you're
you're
aware.
not Cliff.
Yeah, exactly. But I thought your thread sort of quoting him and then sort of your long passage, again, you weren't offering legal advice, nor are we offering legal advice here or compliance advice on this, but I thought it was very helpful and very informative. It took us a while to sort of realize that the world has changed, that funds are more open about what they're doing, not only in their operations and structures, which what was a lot of what we're talking about here today, but in terms of their processes and the types of ideas they look for. And that the world has changed in that regard. Now, I think people have sometimes taken it too far and just gone full open and outright promoting themselves out there. And look, we operate in a regulated industry and it's regulated for good reason. And so we approach this with a very high level of paranoia. We have a compliance firm that we rely upon for a lot of this. And we went to them before engaging in any of this. But the decision to do it, to even start a Twitter account to begin with, was born out of a conversation we had with one of our old colleagues who's a fundraiser and a longtime hedge fund executive who had actually, after our last firm closed, he went to go work at an allocator. And he told us firsthand, he had done a handful of allocations to managers he discovered on Twitter. He liked their thought processes. He liked what they were saying. And so he said, his advice to us was unequivocal. He's like, you have to have a Twitter presence. So we started, very slowly. I'd say generally our experience has been pretty positive on it. There's obviously a lot of toxicity and stuff out there. We just generally don't engage in trading a lot of information about ideas or positions. A lot. It's generally like we'll share news about certain stocks that are out there. We'll opine about stocks we are involved in or are not involved in, and we won't clarify we own this or we don't. And I think that generally helps us steer clear of a lot of these compliance issues of people sort of promoting their own books. I think a lot of things too we'll oftentimes talk about just a business or an industry or a business that's having a lot of success that we're just very supportive of that business or of that industry because we might like it. And so, in terms of a story, I think, look, our largest position had a very high short interest, and there was out there an investigative short seller who does, I think, pretty good work. That came upon us because of some of our tweets, just, mentioning the business or the industry, not necessarily a stock position. But as a result, they reached out to us and said, hey, we're doing work on this. And actually, I don't even think they directly reached out to us. They knew another manager who knew of us, but they had seen some of our tweets about this. And they reached out to us. And we didn't send them a body of work or research or anything, but we said, look, if we were doing work on this industry or this company, here are the places we would go. Not the least of which is talking to the customers in this industry. Have you guys talked to the customers in this industry? If you haven't, you should. And some of them would probably be pretty open. That investigative short seller shop went and did a whole body of work. And as a result, issued their first ever long call on this stock from doing that research. And that to us is a net positive sort of interaction about having a bit more transparency, within this sort of Twitter X sphere overall. So it's generally been pretty good. I think we steer very clear of making investment recommendations or offering estimates. People will say, oh, what's your estimate? Like, no way, I'm not going to give you my math on that. But we just always tend to want to be on the conservative side because you want to sleep really well at night doing this, but we also want to take advantage of this sort of community that's opened up out there. And we want to be, out there in front of people. And I think if you look at our social media presence, it does achieve that. It does give you a better look at how we think.
So you mentioned the outsourced compliance people that you ran all this through, that I'm sure you run through your posts, as you're formulating them. How has your service provider or partner suite, as you like to call them, evolved with the growth of the firm?
I'd say most of them have changed. The advice here for running a business, starting a business like this, is you get lots of advice and there's lots to choose from. It's unclear what the differentiating factors between any of them. And until you actually sit down and play with the portal, play with the prime brokerage portal, or play with look at the admin report and look at their website. And so there's a lot of advice at the outset, particularly if you're trying to raise institutional capital, that, hey, if you're going to choose, you should choose from this set of administrators. And if you want to stretch a little bit because it's cheaper, you go here. But if you start to get into, the lower second tier or third tier, whatever you might call it, then you might signal the wrong thing. You just don't have to answer these questions when you're trying to raise money. And so when we launched, we tried to kind of hug the line of finding an admin that had a good reputation, was not the most expensive, but definitely not the cheapest, and finding tax and audit that was not a big 4, but was like a big 8 or whatever you want to call it. And so we did that. We had an outsourced compliance consultant, the same consultant we had from our prior firm. We had engaged Constellation, who had been the outsourced CFO from our prior firm. And they've all been changed.
You mean acquired by private equity?
/ acquired by private equity. And that's probably the catalyst for the 3 of the 4. That was probably the catalyst for the change. And in retrospect, if we changed anything, we would have gone out of the gates with what we have. Today, we use NAV Consulting as our administrator. They are, we think, phenomenal. They are very tech forward. And compared to our last administrator, who we paid a lot of money to, and ultimately we discovered when we transitioned to NAV that they had done they were basically not doing our NAV calculation correctly. Unfortunately, because of a high watermark issue, we weren't charging incentive fees when we shouldn't have been, but they had hard coded a number and never changed it. And it had gone on for almost a year. But we caught it. And we have NAV and can't say good things about them. They, yes, there's a little bit of turnaround time sometimes because the hours are different and almost everyone doing the work is in India. So if you need a super urgent reply to a question, but even then we can get somebody on the phone in Chicago and they can probably get us the answer. But we get our NAV back done quickly. Their portal, in terms of information you can get from it and the ease of use, they have a mobile app. I mean, it's night and day versus what we had. And we loved Iser Amper, but they got acquired by private equity and the prices went up and the service went down. And then we made a change and realized that, like, wow, we don't have to wait until tax day to get our K1s. They actually could be done pretty early with a much smaller auditor who does great work.
Which turns out is like 90% of what LPs care about.
Yeah, which is
And their K1s in February, not April.
Yeah. K1s is a big one, particularly for smaller investors. And then the audit, we occasionally get asked to see an audit, but it's not very often. But we're required to do it, being regulated in California. So we have definitely brought the budget down, yet at the same time feel like we've gotten the same or better service in a lot of cases. So, and starting day one, I wish I had picked all the ones we have now, rather than what we started with. And we found IQEQ, Constellation acquired IQEQ. IQEQ prices went up and service went down. And we found a boutique outsourced CFO guy who's got one partner, two-person business, and they've worked at other large hedge funds, and he's got a handful of clients. He's a tremendous resource. And so it is all manual budget. So you can do it cost effectively. And we encourage anyone going through this process to really explore all the choices. I'd say, like, tune out the kind of, you should really, you can signal with your service providers, and the probability that that's going to matter versus like giving you an extra 2 years of runway because you didn't burn an extra $150,000. I'd take the 2 years of runway every time.
Maybe you don't want to have the same auditor as your like top 5 short positions or something like that. But there's a middle ground.
And back to kind of what we're talking about at the beginning, that's where salesperson at a prime broker can be a great resource. They are friends with all of the people, and they will introduce you, and they will ask for color commentary on, hey, who does the best work? And that's our CFO might know that too. And the admins also, it's helpful to hear from tax and audit who has the best financial reports. NAB is really easy to work with. They get it done super fast.
So we've been talking mostly about these service providers, partners on the operations back office side, but also there are a lot of tools out there now for the front office team, for the research side, and specifically around AI and the new tools that have come out recently that are, ChatGPT. People I'm sure have played around with it, but now there are tools that are specifically designed and being built for professional investors. And actually, I know that you guys are going to be speaking at Fundamental Edge's AI Bootcamp that's coming up in September, where they have a lot of different fund managers, technology providers, et cetera. You're participating in that because it's been a huge part of the evolution of your process. So I'd love to get into when you started to play around with AI, how that has evolved, and where we are today, and as well how it's affected the cost structure of your business. And
It's super topical, and we spend a lot of time thinking about it. We're maniacally focused on return on time because it's Cullen and I. We have an analyst in India. We run a lean team from a research perspective, but we want to get as much done in terms of fast failing ideas as we possibly can. You just can't afford to waste time on bad ideas or time period. It's funny. So at the beginning of the year, we were actually looking to hire an analyst, and we'd actually reached out to Brett in Fundamental Edge because he runs this phenomenal analyst training academy. So he has a great database of resumes, and he kind of knows who's good. But at the same time that we were putting together what we thought was a thoughtful and detailed job description, specifically outlining what we were looking for, which is also just a good exercise to do internally, a lot of these new AI tools started to come up on the scene. And when I say these new AI tools, I'm still talking about like sort of the horizontal ones, the general purpose ones, not even the more sort of financial industry focused ones that have really, I feel like, accelerated in the last even just a few months. And we realized from trying out a lot of these, and it's funny because the research budget for these is actually not a lot. You get to try it. Some of them are $200 a month, but they're not a year's contract. So it's worth $200 to try one of these for a couple of weeks. And we realized pretty quickly that sort of 75% of what we were going to want an analyst to do was going to be able to be captured by these AI tools. Like there was going to still be an onboarding and figuring out the right prompting and everything else we would need to do, but there's always going to be an onboarding with an analyst. It's probably going to cost you, even more time. And so much of this was sort of interesting to toy around with. And I think it's interesting because there's a lot of talk out there on Twitter about the analyst job being dead now. And, RIP, the investment banking analyst, or the analyst that works at a hedge fund because of these AI agents. And look, I just gave you a reason. We were going to hire an analyst and now we're not. That's got to be horrible for it. But the reality is what it means now is a good analyst or a great analyst, that definition just changes now. It's not being able to go through that 10K, get those footnotes and do the financial model. It's actually going to be engineering the right prompts. It's going to be figuring out how to get out of these AI agents and tools that are out there the most pertinent and accurate information that you possibly can in the quickest way possible. So typically, if Cullen and I were expecting that an analyst we were going to hire was going to process 2, maybe 3 ideas now, maybe that person could, process, 5 to 10 ideas. And so we may ultimately still end up hiring that person, but we're in a pause mode until we can see what that job description is exactly going to look like. And, bringing it back to sort of what's happened, even, we're sitting here in August of 2025. And I think in the last 4 weeks, there's been like 5 other Excel agents for AI that have come up. I mean, it's incredible the speed at which these are all, arriving. We're trying out now mostly the vertical focused tools for this industry specifically that have helped. And we've had some that have been total busts and some that have been very successful. I think, Portrait AI or Portrait Analytics rather, that's run by David Plon has been one of the best resources we've found there. They're kind of doing this Alta Vista type approach, or maybe like a Perplexity type approach where you're putting in a query or you're using it for screening or monitoring, and they're on the back end sort of doling subparts of your query out to different LLMs based on what they deem to be the right LLM or the right one for that task. And then they bring it all back together and present you with sort of a unified body of information. The accuracy, the sort of contextual understanding behind what you're looking for, I think it's all there. And there are other products in and around that are doing it. And so we're getting a lot of use out of tools like that. And, you know, I'll give you an example, just generally speaking. We brought over from our last fund, and we make a lot of use of sort of these proprietary screens that are built around our investment principles. Just try to figure out and filter up every day, what are the ideas that are most likely going to be interesting to us? And 90% of that is really quantitative. You're using Bloomberg data, things like that. These AI tools are offering you the ability to add a lot of qualitative filtering to it. So one source of sort of change and misunderstanding for us that we've often really found a lot of value and success in is management change. What are companies where you've had a CEO change? Now, CEO changes, especially in small cap, happen every day. Like there are dozens every day. So if you're just filtering for like, find me a company with, you know, I don't know, a minimum market cap of 500 million to a max of 5 billion where there's a CEO change, you're going to find a lot of things. But when you add in some of the features you can do with AI, which is find me a company with CEO change where the CEO has actually been there for at least 5 months, because I don't want someone who's like going to come in and like they're going to have to reset it immediately. So I don't want to be involved at that point. But I also want someone who's not an interim CEO. That's not a quantitative field necessarily. I want someone, you know, I don't want someone off the board who's coming to sort of babysit this company. I want an outsider CEO. Not only do I want an outsider CEO, I want an outsider CEO who has previously run a public company, and I want that public company's stock during that person's tenure to have done well. And you can really start to filter down. And we have a software name that we've added in our portfolio in the last couple of months that we actually came across using some of those AI filters on top of the quantitative filters. So it's hugely, hugely accretive to our process. And you can imagine it would have probably taken a junior analyst maybe a little bit longer to filter through those ideas and find it. So it's extremely powerful. I think what Brett's doing at Fundamental Edge, and it's admirable because in a lot of ways, the arrival of these AI technologies has sort of totally thrown out Brett's prior lesson plan that he's done for the last couple of years of like, here's how I train you to go be the best analyst at a hedge fund. It's like, it's totally changed now. But Brett's now at the leading edge of figuring out, or the fundamental edge, I guess, of figuring out how to make the next analyst best with a whole different set of skills. And so I think it's going to be really interesting to see what comes out of that program. You know, it's going to be really interesting to see, you know, what makes a successful person now. Cause I believe in the, you know, you talk to or you listen to what, you know, Nadella or Zuck or any of these guys are saying about AI and what it's going to do. I just think it's going to be a force multiplier, and we're going to be able to get a lot more work done. And I think that's absolutely going to apply to our industry. But, you know, it's funny. Just one other thing I was just thinking about literally this morning was, you know, you could say that AI is going to take away the analyst job, but there's certain things that analysts can do that AI can't do. Like they can't go attend the Morgan Stanley conference or go do primary research. And then like literally just this morning, AlphaSense announced an AI interview for expert networks, which just like, oh, wow. Okay. Maybe this is going to start replacing even more and more. But I'll tell you 10-1, like that AI interview is not going to be able to suss out the important things that it would take, you know, a human to be interacting with a person on an expert network call to get that are going to be important.
I just echo what Raj is saying. We're seeing new tools every day. We just struck up another trial with something similar to Portrait, but maybe different use case. And we haven't even tried. I mean, we've been looking around, but that one was a reference. Hey, have you guys heard of this? Like, never heard of this thing, and we've been impressed in the couple weeks we had it turned on. And so, and they're all still really early innings in what they're building. So I think our ability to surface new ideas is where it's probably most impactful. Surface at potentially actionable new ideas. I think that doing the heavy lifting and the work, yeah, you can get a deep research report, but like, is it right? You know, and like, there's some informative stuff in there, but also like, can you trust everything you're saying or you're reading? We definitely run into that issue, but getting up to speed on a company is, I mean, it's cut that time significantly. And so it's just accelerated the pace at which you have to jump to, all right, now I need to go find 12 people who've worked at this company or compete with this company to ask them what's going on. But I think our ability to get to what are the core issues? Yeah. What's happened in the past? And is this going to be interesting? Has accelerated really in the last, 6 months. So we're excited.
What about the PM role? Is it coming for your jobs anytime soon?
It's coming for all jobs,
Yeah.
I don't know, but you can have mine.
Yeah.
It is highly likely that there's going to be fully AI investment for a job. They will just be computers making decisions based on all the things that we told them. And they'll be selling and buying stocks from computers that are also making those decisions. And passive strategy in itself is kind of just computer-based decision making. It's an interesting thought process as you go down this path, and is what happens to human active managers. Will there actually be more or fewer opportunities? Because if there's a bug in the system, the odds that this goes, and there's lots of bugs in these systems, the odds that, you end up with a significant pricing because something is really misunderstood. We may see more of those.
Yeah. It could be a big net positive for at least the niche of what we do.
Yeah.
But everybody wants to believe AI is a big net positive for their job. So we'll see.
The interesting thing about our evolution on this thinking too is at the beginning of the year, I really thought Bloomberg was going to be the sort of sleeper, winner here just because of this point that Cullen made, that the data is generally wrong so much. And everybody out here is building an LLM and they're trying to go license it from, S&P or Cap IQ or FactSet or whatever. And obviously those service providers are also very paranoid about who they license to and what they do because they want to build their own. Bloomberg sits at this sort of unique position of having all of this data and then having obviously a lot of money and P&L to spend behind this. And we've been fortunate enough to, again, and we talked about this earlier in the conversation, we tell everybody we're an open book. I'll say, we will beta test everything out there. We love being guinea pigs on the step. Bloomberg and I don't know why, but Bloomberg came to us and they were like, hey, we'd really love you to guinea pig our AI, our chatbot agents. Right now we have 2. We'd really love to do it and give you feedback. And we're like, yeah, we'll absolutely do it. We pay so much for Bloomberg anyway. We feel like we should do this. And I've been disappointed so far at what I've seen. The data is there, it's right, but what they're missing is sort of the LLM language part. And not to be ageist at all, but we had their engineering group in our office to sit there and they were asking us a bunch of questions about what we do, trying to get a better understanding of how we use these tools and how we use these other tools so they could get, I think, a better competitive framework. The average age of those engineers was probably like 50 years old. I was just looking at them and I'm like, guys, you are not going to win this. What are we doing here? You guys need to hire some young blood here if you're really going to win this. So I'm still holding out hope because they do have the cleanest and best data, but there's still some big holes in what they're doing relative to, I think, what some of these other upstarts have in capability.
Well, I want to close with just the future for you guys. You've seen tremendous growth over these last 4 or 5 years. What's next?
More of the same. Raj and I want to keep doing what we're doing today, which is this kind of market cap spectrum and these types of opportunities. We tell people we meet, there's more capacity to do what we're doing. And to have in the next few years, a business, we think it's probably a couple $100 million, and we get to keep doing this form of investing with a small team. And, hopefully we have to pass and actually add somebody and get even more leverage out of these tools that are coming. And so, we're always technically active fundraising or always technically fundraising. I don't know if we're ever actively doing it, but we have many times had a full start of we're really going to get out there and this is going to be the year we're going to do it. And that was supposed to be at the beginning of this year in August, and we haven't really done it yet. So we'll see if we get there, but I think we want to keep this partnership intact, and working in the small team is great, and getting to look at really interesting ideas where you can get really excited about making a lot of money. We are, maybe someday going to try to go out there and actually raise a little more capital for a commingled fund. That would be the easiest path forward, or, a large SMA that looks like the commingled fund. Back to fundraising challenges in the end of late 2022, we went around, we did some active fundraising, and we said, there is some crazy stuff happening. There have been epic dislocations in these newly public companies. We think these are really interesting setups. It's really hard to lose your money here. You might make a lot of money. And many people said, that's super interesting. Let's see how it plays out. And then we had a really good 2023, and we went back and said, it's been playing out. We still think there's lots of upside. And everyone said, man, I guess it's over. Congratulations. That was a really good job. Good job executing on that. But there's probably not a lot of de-SPACs left, or there's not any more of these orphaned securities. And so but we didn't ultimately raise find some clients where it resonated along the way. And I would, a long way of saying all the things we're seeing right now really smell and feel like 2021 all over again. And so we may very well go through the same cycle of floating all these companies. Figma triples on its IPO, 100 new SPACs get listed, and then the world implodes for some reason. We don't know what, but something will happen. Everyone sells them all immediately, and we go back to the cycle again. We find a bunch of new exciting opportunities. And finding a partner who wants to ride that next cycle with us, in a strategic anchor type investor would be great. So that's our objective.
I think the future for us too looks probably a bit more open and transparent than I think we've been in the past. I think we've found that's benefited us. I think it's helped other people to understand who we are and how we invest a little bit more. It's helped us to connect with other people who do similar things and share ideas. So I would expect us to do a bit more of that in the future, which I think is part and parcel with what Cullen mentioned on, we'll do some more fundraising as well.
All right. Well, gentlemen, thank you so much.
Thanks for having us.
Thank you.
Looking into the AI Academy from Fundamental Edge? Check out the link in the description to review the curriculum and reserve your spot today. Thanks for watching.